Singapore REITs are down again and back to nearly 1 year ago. The reason is because the US Fed has expected that the rate cuts in 2025 will not be so deep and it will be of a slower pace. But is this an opportunity for us to bargain hunt for REITs again? In this video, I'm going to show you three S REITs that are stress tested for this higher for longer interest rate environment. But before that, if you haven't done so, do join my free weekly newsletter where you will get tips on the US and Singapore stock markets, stock ideas, analyst reports, and many more. You can find the link down in the description box below. So without further ado, let's jump back to the video. If you can see from this federal funds rate chart over here, you can see that in the past 10 years from 2014 to 2024, okay, the rates have increased from nearly 0% since January 2022 all the way to 5.3% in the beginning of 2024 itself. And what a lot of REIT investors project or predict is that the funds rate will come down sharply in year 2024 and 2025. However, that is not the case because as a lot of news articles have been generated, right, have been written, the sensing is that there is stubbornly high inflation and hence the interest rates are likely to remain higher, like maybe around 3 to 4% for a longer period of time. And what a lot of REIT investors are worried is that with this happening, right, a lot of REITs are forced to refinance with a higher interest rates going forward. And this will impact what? Impact the distributions per unit because they have to pay higher borrowing costs, which will result in lower distributions for us unit holders. And hence, the share prices of all these REITs have come down again. So with that in mind, we decided to come up with three criteria to stress test the REITs that we want to take a look at. Number one is of course low gearing ratios. We don't want REITs to overextend themselves and run into trouble when they don't have enough bandwidth to refinance their debt. And if you are over leveraged, what happens is that banks will, like they will tend to get worried. They will knock on your doors and ask you to pay up, and then you have to risk going for rights issues, and then rights issue will lead to lower share prices, and then everything will spiral downwards. So that is the first thing that we want to, of course, eliminate, right? So you don't have too high a gearing ratio. Even though MAS set a 50% gearing ratio, we believe that 40% is more of a benchmark that we want to focus on. Okay. Second thing is the low borrowing cost, which is what you will look at as cost of debt. This gives us another form of safety buffer when it comes to higher for longer interest rates. So although interest rates now may be coming down, but we don't know whether it will continue to stay there for like 4% for 2 3 years to come. So we want REITs which have very strong and defensive kind of assets that will or maybe very strong sponsors behind them, such that the banks will lend them money at very low interest rates. Um, what I were to take a look at, when I take a look at all the REITs in Singapore, 3% is more of the lower end as compared to, REITs can sometimes go up to 5%, 6%, and that would be, around the range 3 to 6%. So of course, we want to lean towards the lower borrowing cost of around 3.5%. And the third one will be ongoing asset enhancement initiatives or AEIs in short. The reason being because we want the REITs to create value, okay, without just borrowing money to acquire new projects, new properties that will lead to higher debt, okay, and to be honest, it's very risky um, in this period of time. This strategy will work, when low interest rates are everywhere. Okay, so that would be like you are getting funds on the cheap, you will definitely want to grow aggressively. But with the interest rates being so high, you want to be careful. Okay, you want to keep your cash powder over there and grow organically, right? So maybe expand your adjacent land size or do some improvements to your uh, property structure so that you can increase the rental and things like that. So these are the three criteria we will take a look at. The first trust that fulfill all our three criteria is none other than FLCT. So going to page number 5, we can see that they have an overview or a summary of everything that we need. So first point is the leverage ratio, where they are at a very comfortable 33.0%. And what I would say, based on the other REITs and trusts out there, 40% is like the average, okay, and they have 800 million debt headroom to reach this 40%. And MAS is saying that 50% is the the cap, but they are only at 33%, so very comfortable level over here. The second thing that we are looking for is, of course, the borrowing cost, and is also at a very low 2.8% on a trailing 12 months basis. 2.8% is lower than the average of all the trusts in Singapore, right? And although it has gone up a bit to 3.1% on the past 3 months basis, I still feel that it is doing very well on this front. The third point that we always look at is whether there's any organic growth or not, or you are just acquiring to grow your portfolio. But from here, we can see that they are able to increase their rental by 23.6% for the overall portfolio, which is absolutely crazy. When you see other REITs out there, their rental reversion is negative or maybe just single digits for the entire portfolio, but over here is 23%. So I'm not sure whether this double digit growth will continue on a recurring basis like in the next few years. But what I'm seeing here is that at least there's very positive rental reversion. And if I were to scroll down and take a look at their operational developments right over here, right, I can see that they are doing some new developments like freehold lease out to this particular airport in Netherlands, and also in Australia. Okay, this Central Park office tower, building occupancy rate increased from 83% to 94%. So there are things going on, okay, and it's very positive developments. On top of that, they are also doing acquisitions because they still have a lot of debt headroom, and this is in Singapore. So if you are interested, I think you can go down to this Tuas Megaport to go and look at this logistics facility that they have built. And right now, the occupancy rate is at a very healthy rate of 94.6%. So overall, this fulfill our three criteria. With that, let's move on to the next trust that we have. Next up, we have a very popular REIT or trust. There's Maple Tree Industrial Trust. All right, so this is the presentation as of November 2024. Just a quick overview of why it is very popular among REIT investors is because they're quite well diversified with 140 properties, and they are very big on the data centers with 54% of their portfolio in data centers. And this is the next big thing, right? They are able to ride the data boom because of that. um, Now let's move on to our three criteria that we want to take a look at. So first point is the leverage ratio. They are at a very comfortable 39% as of 30 September 2024. Okay, so they still have a strong balance sheet to pursue growth opportunities. And you can see that a lot of their properties are in USD borrowings. So this is something that we also need to take note, whether that when it comes to refinance, their borrowing costs will increase because 63% of their debt is in US dollars. But that being said, if you take a look at their borrowing costs, it seems that the banks or the financial institutions are of the notion that their properties are of quite high credibility, right? Or maybe the sponsor, the Maple Tree branding is there, such that they are able to offer such cheap borrowing cost of only 3.2% as of 30 September 2024. And the last part is whether there's growth opportunities not just from acquisitions but also their organic growth. You can see that they have a very robust track record. Okay, their portfolio have been growing since their IPO in FY 2010. Okay, on how they are constantly doing AEI, they are constantly revamping, okay, to suit the industrial properties, that kind of thing. So although there are a lot of acquisitions, but you can see that they have a lot of AEI projects as well and built to suit, which the recent one is as of financial year 2022-2023. They have grown their portfolio from 2.2 billion to 8.9 billion already. That is fantastic, right? The last one on our list is Parkway Life REIT, one of the largest healthcare REITs in Singapore, okay, with Mount Elizabeth, Glen Eagles, and 60 nursing homes in Japan, as well as one medical center in Malaysia that is part of the entire portfolio. Okay, so their entire portfolio size is 2.24 billion, and 63% of the gross revenue comes from the three hospitals in Singapore. So it's very defensive because they have a long-term lease structure in place, and given that it's hospitals, it's nursing homes, you can expect very stable income stream supported by regular rental reversion. Talking about their capital management or the balance sheet front, they have a gearing ratio of 37.5%, very manageable as well, below 40%. But the most interesting part is their ultra low all in debt cost at only 1.36%. Imagine the banks lending you money at only 1 plus percent. That's also fantastic, right? It has to, is a telltale sign of how stable their properties are, given the fact that banks are willing to lend you at only 1 plus percent. So they won't be scared that there's any crisis happening, like office streets, tenants running away, that kind of thing. The best part about being a healthcare REIT is their distinct kind of lease structure. So you can see over here that they have very long-term master leases with 20.4 years from 2022, and they have the option to renew another 10 years. It's crazy compared to average industry lease of 3 to 5 years. And what they have is this very unique rent review formula that they are paying a base rent plus a variable rent, and it has to be comparable to the inflation rate. Okay, so this ensures that their rental is going up every single year. Okay, this is true for their Singapore portfolio and also their Japan nursing homes, where they have a up only rental review provision, and this resulted in a very healthy recurring DPU growth since their IPO. So DPU has grown 133.7% since IPO in FY 2027. Okay, and you can see how it has been on a very stable, steady trajectory. And not only that, they are doing acquisitions as and when there are very good opportunities. In fact, okay, they did a placement to acquire 11 nursing homes in France itself. So 60 nursing homes in Japan. Now they are moving into France, into this third key market for them. Okay, you can check out the details over here. But is DPU accretion of 1.5%, expected to be completed fourth quarter 2024. Okay, again, this is backed by very favorable lease terms and it's 100% occupancy rate. So in short, right, they are going big on nursing homes, healthcare sector, very stable growth for Parkway Life REIT.